The pound is learning a hard lesson right now. On Wednesday, the 26th of August, 2026, pound sterling to US dollar has slipped below 1.3620 after failing yet again to break through 1.3660. This is significant because that resistance has repeatedly capped bullish attempts, turning last Friday's 6-month high near 1.3675 into a firm ceiling rather than a launchpad. The daily relative strength index has cooled to around 65, down from overbought levels, which tells you momentum is fading but not exhausted. In plain English, traders are taking profit ahead of this week's critical US inflation data. This dip is not a verdict against the pound, it is a pause in the broader dollar weakness story. The US Treasury has announced it will double its long-dated bond buybacks to at least $4 billion per operation from September, which initially pushed Treasury yields lower and weighed on the dollar. At the same time, Philip Wee of DBS Bank argues that Federal Reserve Chair Kevin Warsh must explain how the central bank can anchor expectations without forward guidance, and how much tightening it will tolerate through long-term yields. On the UK side, Governor Andrew Bailey warns that Middle East conflict is causing severe volatility in energy and oil prices, a risk that could push UK inflation back toward 3.2% later this year. That energy warning matters because the Bank of England's base rate is 3.75%, while the Federal Reserve's target range is 3.50 to 3.75%. That leaves very little yield cushion for the pound, so any energy-driven inflation surprise would put immediate pressure on the Bank of England's policy stance. July's data already highlights the tension. Headline UK inflation rose to 2.9% year-on-year, yet retail sales growth tumbled from 3.8% to 1.6% and the PMI came in soft. In practice, traders have trimmed bets on further Bank of England tightening, which is exactly why sterling cannot convert broad dollar weakness into a clean break higher. The immediate catalyst is the U.S. July Personal Consumption Expenditures Price Index, the Federal Reserve's preferred measure of inflation. The core reading is expected to rise 3.3% year-on-year, and Elias Haddad of Brown Brothers Harriman expects it to echo the softer July Consumer Price Index and retail sales numbers, which would give the Fed room to stay on hold. He also suggests watching the Dallas Fed trimmed mean and Cleveland Fed median PCE measures for a cleaner read on underlying inflation. Then on Friday, Kevin Warsh's appearance at the Jackson Hole Symposium could set the dollar's tone. If his comments suggest tolerance for higher long-term yields, the dollar may rebound and drag sterling towards 1.3580. If he sounds cautious, expect a retest of 1.3660. The takeaway is that pound sterling to US dollar is not breaking down, but it is trapped between two clear levels. Resistance sits at 1.3660 to 1.3665, the zone that has repeatedly rejected recent rallies, while support rests near 1.3580 to 1.3600. As long as the Bank of England is dealing with energy-driven inflation risks and the Federal Reserve is dealing with a communication gap, expect choppy, range-bound trade rather than a clean breakout. Watch the PCE print and Warsh's Jackson Hole message, because those two events, not UK data, will decide whether this week ends above 1.3660 or slides towards 1.3550.